Let's get oriented. I'm Lázaro Ulloa, owner and founder of Ulloa Financial, and this is your market compass for the week ahead for Monday, April 20th, 2026. Last week was a reminder that markets can reprice fast and just as quickly reprice again. For a moment, it looked like the pressure was coming off. Midweek, investors responded to headlines suggesting the Strait of Hormuz would remain open and that diplomacy between the US and Iran was making progress. Oil dropped sharply and stocks rallied into the end of the week. That was the relief trade. Lower oil meant lower inflation pressure, less stress on interest rates, and renewed confidence in risk assets. But as we head into today, that relief is already being tested. As we watch the pre market action this morning, we are seeing exactly why that relief trade was so fragile. Over the weekend, Iran reversed course and reasserted control over the strait, and oil is moving higher again. So the market ended last week on relief, but it begins this week with that relief very much in question. That is the real setup now. The market is caught in a tug of war between strong earnings and volatile energy map. And this is where the interest rate comes into focus. The 10-year Treasury finished the week at around 4.25%. Think of that level as a line in the sand. If yields stay below, stocks tend to have some more breathing room. If yields begin to push meaningfully above it, valuation pressure increases quickly, especially for growth and rate sensitive sectors. So this is not just a number, it's a signal. Inflation is part of the story as well. March CPI came in at 3.3 year over year with a sharp 0.9% increase for the month. And that monthly increase is one of the highest we've seen in years. And here's the key nuance. That spike was driven largely by energy, which brings us right back to why the Strait of Hormuz matters so much. This is not just geopolitics. It is inflation pressure in real time, and it puts the Federal Reserve in a very difficult position. Now, add earnings. Earnings season is off to a solid start. Companies are beating expectations, particularly in financials, but the tone of guidance is more cautious. The question now is not whether companies performed well last quarter. The question is whether they can sustain those results if costs rise again and demand begins to soften. So here's the key takeaway from last week. Yes, the market rallied, but it rallied on a temporary easing of fear, not on durable clarity. Now let's look ahead. This week is about confirmation. First, earnings quality, not just who beats, but who guides with confidence. Second, oil. If crude continues moving higher because of renewed tension, inflation concerns can come back very quickly. Third, yields. Watch that 4.25% level. If it holds, the market has room to stabilize. If it breaks higher, pressure builds. And fourth, participation. Last week's rally was strong, but this week we need to see whether it broadens or narrows. Now let's bring it back to you, because this is where it becomes personal. Oil prices, interest rates, and corporate earnings do not stay in the market. They show up in your daily life. At the gas pump, in travel costs, in groceries, in borrowing costs, and in how far your income actually stretches. When oil drops, your budget gets a little relief. When it rises, it quietly takes that relief away. And when interest rates stay elevated, everything from mortgages to credit cards become more expensive to carry. So for the long-term investor, this is not a time for reaction. It's a time for alignment. Is your financial plan built for an environment that can shift this quickly? If you have higher risk tolerance, stay selective, not aggressive. If you have lower risk tolerance, stay anchored. Protect liquidity, manage risk, and make sure your strategy matches your reality. Here's the bottom line. Last week's rally was real, but this weekend was a reminder that the foundation is still fragile. The market can move higher if earnings hold and yields stay contained, but it is doing so with the geopolitical risk sitting right underneath it. So this week, watch earnings, watch oil, Watch that 4.25% level. And most importantly, stay focused on your plan, not the noise. Stay oriented, my friends, and elevate your legacy.